Welcome back to the second half of the Futures Show. We're less than 60 minutes away from the cash open for stocks on Wall Street. Let's bring in our next guest, Scott Bauer, the CEO of Prosper Trading Academy, joins us to continue that financial focus. Scott, thanks. Welcome. No data at the bottom of the hour for us to look at. So let's dive right into markets. First, the U.S. dollar, the strength we saw into the end of January, precursor to what we should see or could see as we embark into the month of February.
I think so. And you and JB had a great conversation about it. And we are seeing the dollar coming off those highs just a little bit right now. But honestly, I think that's really due to end of month flows, leaving investors, really needing to sell dollars into the last week on this last rally here. But, the improved risk appetite in the stock market over the last few days, that could also be playing a little bit of a role as to why we're seeing, the dollar come off a little bit, Ben. But I do think that strength that we have seen is going to continue.
A good reminder there, the dollar does oftentimes get a bit of a bid when we see that volatility come into the market, and we certainly saw that into the end of January. Here you can see the dollar recently up to 97.44. Now, I just want to remind everybody, for those of our viewers who don't have access to the ICE products, the dollar is, again, an ICE product. You're going to have to pull up the $DXY. This is the index on the right. I've got the futures on the left. Again, the index on the right. And you can see, you can track each other very closely, and for the most part, tick for tick. Talk to us a little bit, Scott, about some of the other currencies you have your eye on this week, because it's not just the dollar coming off that high from last week, 97.44. We're looking at it right now. In the index, it got up to 44. But we also have a lot of focus on the British pound, the euro currency. We were just talking about the Australian dollar, New Zealand dollar, which have been coming under pressure recently, and another safe haven currency, the yen, ultimately. I mean, with the indices coming off, these are all focal points.
Absolutely. Let's start with the yen. The dollar also fell just recently against the yen, now trading around 114 and a half or so. But also it fell against the Swiss franc. Mm-hmm. Again, though, I think those are just temporary. I think those are just, over the last couple of days with the big rally in the equity markets, you're seeing a little bit of that, safe haven mantra, if you will, coming off a little bit. But now you look at, what's going on in Europe, both with the British pound, with the euro, and you know what? They're both saying they are, planning on keeping this ultra loose monetary policy here with minimal, if any, rate hikes for the year here. Then you talk about the Aussie dollar, which has been really strong, really on fire, but has dropped sharply in the last few days because, again, what they're saying there is they're pushing back against really imminent rate hikes or projected rate hikes for the year. So, overall, the dollar's trajectory is still to the upside. And I think you're seeing some of these other currencies that are strengthening here, not the Aussie, but talk about the euro, British pound, the yen. I think that is going to temper quite a bit.
You mentioned the euro currency. We have the ECB on Thursday, but we've seen the German Bund firm up quite a bit. We talked about it last week as it was on the move higher. And, again, it's definitely points to investors, traders suggesting it's not so much a matter of if, but more a question of when.
Absolutely. And I think when you look globally here and maybe the U.S. is ahead of the rest of the world as far as not just inflation, but strength of the recovery. But you're right. It is a matter of I think, is it going to happen? When is it going to happen? I think we're going to have to see globally rate hikes across the board, unless there's something that catastrophically comes in to hurt the world economies here. Sooner rather than later, we are going to have to start seeing hikes across the board.
Scott, talk to us about what you're seeing as far as the yield curve. There's been a lot of focus on that short end relative to the longer end. We know, again, that it's more closely tied to the Fed, and with this hawkish tone that we've heard recently, you can understand why the shorts moved at the rate that it has, but really the long end really just has yet to participate.
Absolutely, and a quicker pace of rate hikes, and all of the talk that we've seen about not just a quicker pace, but possibly a 50 basis point hike in March, which I don't think is going to happen, but this quicker pace of rate hike, that is dampening future growth expectations.
Okay.
And you can see that playing out in the bond markets as the short and the long end of that yield curve are now converging quite quickly here, if you will. And if you look at where we were just a couple months ago or 3 months ago or so in the fourth quarter towards the end of November, we're now below the spread that we were at that point there. I think we're below a 60 basis point spread now between the 2 and the 10. And, this curve is flattening. And as you said, what the Fed looks at when they tighten and what it affects most people and consumers, that's the short end of the curve.
Yeah. You bring up a good point here. You were just talking about 2-3 months ago. I mean, in many ways, 2-3 months ago, Scott, we were talking about potential for maybe 2 rate hikes this year. And now, as you again pointed out, there's a lot of speculation. We could see a half a basis point in one of those hikes and all the way up to maybe 7, as many as this year. Scott, ultimately, talk to us a little bit about what this means in terms of the overall risk-on sentiment that we had seen in the environment that had indices and that trend environment to the upside, seemingly nonstop. Bitcoin, for example, reflection of how it's shaken, stirred, certainly, and we're seeing some cracks in the dam, basically, in terms of some of that real intense risk-on sentiment, kind of buy with both hands, eyes closed type mentality. Stock pickers seem to be a little bit more selective over the last few weeks. You expect this to continue?
I do. I don't think the volatility is going away anytime soon, but I also don't think that the Fed is going to be as aggressive as what we're seeing in some of the media, some of the markets right now. I just can't fathom, cannot imagine how they're going to come up with 5, 6, or 7 rate hikes unless Ben, inflation starts, or keeps at this pace and the economy is absolutely just humming along here. But with what's gone on in the marketplace recently, the volatility we've seen, and quite frankly, a lot of the risks, a lot of the geopolitical risks that are out there right now, I think the Fed is going to be less aggressive than a lot of the talk that we have seen. Are they going to raise? Absolutely, they're going to raise. I just can't see more than 3 or 4 max for the rate hikes this year.
Scott, how about eco data real quick? We have some manufacturing numbers today. Are they overshadowed by the jobs report Friday?
I don't think so. I think the manufacturing data, which we've seen recently, which has been pretty weak, is going to be very important. Yes, all eyes are going to be on the big number on Friday, but it's a long way off until Friday. There's a lot of data we're going to get that's going to affect the market before we get to the January jobs number on Friday.
Okay, we've got some numbers today. Maybe JOLTS will be more important than the manufacturing data. Scott Bauer, appreciate you joining us, the CEO of Prosper Trading Academy, sharing your Tuesday morning with us here on the TD Ameritrade Network. Always good to have you with us. Hey, we're going to take a quick break. Stay right where you are. When we come back, my chart of the day.